have the IDEC portfolio, which is inflation, deflation, economic cycle. I look at the second derivative of inflation, and I look at the context of that second derivative of inflation in the context of economic growth. So I want to have a picture of inflation first and foremost, and then I superimpose the overall economic growth. And so we have been in a disinflation camp for about a year and a half almost already. So that's sector 2, which is the second derivative is falling in inflation in the context of a weak economy. I mean, the real estate market is a very big part of the economy, and the real estate market is frozen. We also have a manufacturing recession. We have, I think, 21 of the last 22 months. We wiped out 4/5 of the purchasing power of the middle class. If you look at GDI, gross domestic income, much weaker than GDP. They're supposed to measure the same thing, but they're not congruent at all. We have a very weak economy in the context of disinflation. And as I said, I'm still positioned for that. So what does that mean? That's bond and bond proxies and gold. That's where we are, sector 2. Now, I think there's a salient chance we could go to sector 1, which is a recession and deflation, not just falling second derivative, but you actually see prices falling. That's the history. That could take up to, going from sector 2 to sector 1 sometimes takes 2 years or a year and a half. I haven't, written that possibility off, but I'm also keeping an eye out. I'm just sitting there saying, I'm, didactically saying we are going into a recession. There's nothing that can stop it. I mean, I believe that that's the case, but I have a model that I'm going to monitor every day and let me know if I'm correct. And so far, there's no reason to change. If you look at 5-year forward, inflation expectations, if you look at commodities complex, currency, level of the real Fed funds rate, quantitative tightening, the condition of the consumer, all those things lead me to believe that just because the Fed is going to go by another 50 basis points by the end of this year, taking the nominal rate down to 4.25 to 4.5, I don't think that solves all our problems. It's going to be too little. It's going to be too little, too late. That's what's happened in the past. It's not an aberration for the Fed to start cutting interest rates, for Wall Street to claim, it's a soft landing. I mean, they did that in 2007 and almost to the fall of 2008. I was on TV every week saying that this is a housing crisis that's going to lead to a recession. And they laughed at me and they said, oh, no, the Fed's got your back. The Fed was slashing interest rates pretty dramatically. In fact, they cut them all the way to zero by the end of 2008. I hope you weren't buying stocks because the Fed was cutting rates. And the same thing happened in 2001. And like I said, in 2008, the issue was housing. It wasn't really a stock market bubble, and it wasn't really much of a credit bubble. It was a real estate bubble. In 2000, it wasn't a real estate bubble, and it wasn't really a credit bubble. It was a NASDAQ bubble. It wasn't even much of a stock bubble. It was a NASDAQ bubble. We have 3 bubbles concurrently off the charts historically. I don't see how you get out of that so easily. What I'm trying to say is don't be so quiescent and be so easily placated by the Fed's put this time around. Just pay attention. If you're in a 60-40 portfolio, you get wiped out on both ends. I have 60% of my portfolio in stocks, 40% in bonds. A lot of those 40% in bonds are in long duration bonds, zeros or maybe the TLT, 20-year plus. And I have 60% in like NVIDIA. And, when you think that's going to save you from a stagflationary recession, think again. So gold is not a commodity in my mind. Gold is a monetary metal. Gold is money. I'm not the first one to say that. So it's proven itself over and over again to be a monetary metal. It's pure money, honest money, real money. So it's not a base metal and it's not energy. The only commodity I'm long right now is gold. I mean, gold has outperformed the S&P for 25 years. It's not only outperformed the S&P, it's done so with much less risk. Its risk-adjusted returns are through the roof. Sharpe ratios, very high. If you look at past recessions, the worst place you could possibly be in is base metals and energy. They get wiped out, both the commodities and the equities. And even gold, and this is very truncated, so gold stocks are stocks. They could get wiped out while gold is doing okay. But when push comes to shove, anything that's not nailed down that can be sold, gets sold in a liquidity crisis. Now, we're nowhere near that yet. So I'm staying with, sector 2, which is disinflation, which is have falling nominal rates and falling real rates, is really good for gold. Now, the nominal part of that, well, you see the short-term nominal is falling, but the long-term is rising. So you're losing that part of it. But you still have, global chaos and conflagrations all over the world. You've got a budget that's just out of control. If you look at both spending plans from both potential candidates, I mean, there's no hard money, balanced budget candidate out there. And gold loves to run away deficits because what do you have to do? You have to print the money to buy those. So you print money, you buy debt, prices go up, yields are capped, but the real interest rate plummets because you have to subtract inflation from your interest rate repression regime. So I'm sticking with gold for now. But on the other side of this, which could be brutal, I mean, yeah, you can time the market if you understand the rate of change of inflation. And the rate of change of inflation could skyrocket, but not now. I mean, the Fed isn't at zero. The real Fed funds right now is still positive, like 200 basis points. If the Fed took interest rates to zero and they started quantitative easing and we started sending checks out to consumers, I would sell every single bond that I owned. I would short the bond market. I would sell anything that's even looks like a bond. But right now they're working. So stick with it because the Fed haven't done that yet. But they will. And that's my real fear. And then when they change, when the market is anticipating that change to occur, here's the news flash for you, or maybe not. The market is based on inside information. So the people who know what's going to happen will react ahead of time. And that's what they do. I think maybe 2% of the population has any damn idea what the Federal Reserve does. And I don't even know if they care. I don't think they understand the process of creating Fed credit and what's it based off of. And why do we have gold as money in the Constitution of the United States? I think it's Article 1, Section 10, I believe. I mean, why did we do that? Why do we have a Federal Reserve? Who says 2% inflation is the magical panacea? Who gave the Fed the right to buy? They created something called a discount window. So a troubled bank can take assets and they can sell them to the Fed at a discount and a penalty rate. And that's how they can get liquidity. But I don't think that 1913, the charter of the Federal Reserve was to go out and buy corporate debt. And I don't think it was supposed to be done to the tune of trillions of dollars. I mean, who gave them that authority? I know special Congress gave them special emergency, blah, blah, blah. I mean, isn't this the rule of law in this country? Well, the rule of law, unless you change the law. And when do you change the law? In an emergency. It's an emergency. Habeas corpus, gone. We don't need it. Civil War. Don't need it anymore. I do look at the headlines because I believe the headlines could lead to a change, one of the 20 components of my model, but only after those components change do I react. I stick to the model. I mean, if financial conditions are easing, even though the headlines really stink and are very scary, I don't care. And financial conditions and credit spreads, financial conditions are tightening and credit spreads are blowing out, the ones that I look at, but there's quiescence in the headlines, I don't care. I will react. That's how I look at things. So you can come up with a lot of scenarios about the election. And, I think it's going to be a divided between the White House and Congress. One of those houses will stay in one place and it'll be a divided government. And that means Trump tax cuts will probably go into sunset, most of them. They'll agree on something, but not all of them. So there's going to be a pretty big tax increase in corporations coming at the end of 25. But my model will let me know what to do and when to do it. And that's why I created it, so I can remove my emotions. If I wanted to go on my emotions, I would be short the market for years. I would own nothing but T-bills and I'd be short the market. I use my decades of experience to say, what happened leading up to major crises? I backtested it. What if I looked at this? Would that have given me a clue? Oh, yeah. And that's why I assembled it. And that's what I use. Is it perfect? No. 60-40 doesn't work. 2022 proved this beyond a doubt. If assets are in a bubble, if you're going to say, I'm going to find protection in the real estate market because the stock market's scary. No, I'm going to find protection in the bond market. Well, bond yields were almost zero. So that part of your portfolio blew up like 50, 60%. In U.S. Treasuries, traded like a small cap, bankrupt pink sheet stock. Okay. And the stock portion went down to like 20 something percent. So when all of your assets are in a bubble, you can't find protection in any of that. I'm diversified. Well, you're diversified into 3 bubbles. You have to be a little more active, a little more intelligent about your assets. The Fed monetized almost $5 trillion of the helicopter money, which was $6 trillion unleashed by both the Trump and the Biden administration. $6 trillion of helicopter money. And that's not only, enhanced unemployment and mortgage forbearance and all that other crap, okay? That went on way too long. And you got 9%. Since 1987, when Greenspan started this Fed put, the salient problem was deflation. It was, asset prices crumbling. But I'm not sure this next time around, go back to QE, go back to helicopter money. Everybody knows it's going to lead to 9% inflation or more. And the Fed has already told us that they have no real willingness or ability to fight disinflation. They have no toleration whatsoever for deflation. So I think there's a very real danger that inflation can go well into the double digits next time around. And you just can't have a 3.7% 10-year note when you have inflation rising at 14, 15%. You just can't. So you have that inflation issue, and you also have the fact that in the next recession, the annual deficit will probably go between 4 and 6 trillion. It'll be about $5 trillion. I think the Fed's going to they'll feel obligated to buy most of that debt. I mean, Powell, I think reluctantly will cut to zero and start building up his balance sheet in reaction to the freezing of the credit markets, which I think is a very real possibility still. I don't think 50 basis points, as I said, solved anything. We still have quantitative tightening going on. The real Fed funds rate is still very much in positive territory. The yield curve just normalized. We had the longest inversion of the 2s and 10 yield spread in history. Well, it has been a perfect indicator of a crash in GDP. So every time the yield curve hasn't been inverted in the past, we've had a recession, except for one time, it was 1965. And that's when GDP crashed from 10% to zero. And it's usually 3 to 6 months after that normalization that you see the recession begin. And recessions have brought the stock market down by 35 to 50% in the past, maybe, and sometimes even more. So I don't think we're out of the woods. This 50 basis points doesn't equal a panacea.